Welcome to today's Explainer. We're looking at a company that is quite literally guaranteed to give traditional value investors absolute heartburn while making growth chasers sit right on the edge of their seats. We are decoding the financial data of Applied Digital, trading under the ticker APLD. Honestly, this company presents one of the most extreme, contradictory, and just downright fascinating financial paradoxes in the market right now. We've got astronomical market caps and mind-bending returns crashing head-on into some staggering cash burn. It's a puzzle of modern market valuation, and today we're going to break the whole thing down together. Okay, let's just look at this number right out of the gate. 11,803.41%. No, that is not a typo. That was Applied Digital's actual yearly return back in 2021. I still kind of have to blink a few times when I read that just to make sure my eyes are working. If you had parked a modest amount of money in this stock at exactly the right time, it would have multiplied nearly 119 times over in a single year. So the immediate question is, how on earth does a stock achieve this kind of explosive, gravity-defying growth? And more importantly, what is actually happening behind the curtain to keep it going? Well, let's dive into it. Here is our roadmap for decoding this paradox. First, a history of extreme returns. Second, the revenue growth engine. Third, the profitability and cash squeeze. And finally, pricing the hype.
Part 1. A history of extreme returns. Let's check out this volatility in action.
Now, what's really wild here is the sheer whiplash contrast year over year. We just talked about that astronomical high of 2021, right? Well, in 2022, the stock suffered a brutal, absolutely crushing crash, losing over 92% of its value. For most companies, a 92% drop is a death sentence. But then, it bounces right back in 2023 with a 266% gain. The year-over-year whiplash here is stunning. It's the ultimate roller coaster. Massive spikes, terrifying drops, and then massive spikes again. But if we zoom out past that brutal 2022 crash, the longer-term picture reveals some massive, sustained upward momentum. Over the trailing 12 months, the return is nearly 630%. Over 3 years, it's a staggering 954%. And over 5 years, it's holding at roughly 445%. So despite the violent turbulence along the way, anyone who actually held this stock over a multi-year horizon has been rewarded with aggressive market-crushing momentum. And you know what? That momentum is very much alive right now. Looking at the 52-week range, the stock hit a low of $4.20 and a high of $42.27. Currently, the stock sits at $32.69. That means it's trading a staggering 678% above its 52-week low. The market clearly believes there is a very, very big future for this company. Part 2, the revenue growth engine. Let's see what is fueling the fire. So here is the top line number you absolutely need to know. $317.4 million. That is Applied Digital's trailing 12 months revenue. We really need to ground ourselves in this number because it proves we aren't just looking at some empty shell company trading on a hype ticker symbol. There is a sheer massive volume of real money flowing into this business right now. But as you probably know, in the growth stock world, the absolute number isn't actually as important as the direction it's moving. And here, the revenue isn't just high, it's growing at a completely explosive compounding rate. Looking at the compound annual growth rate, or CAGR, the 3-year average is nearly 98%, and over the last 12 months, it has accelerated to almost 129%. That means the money coming in the door is essentially doubling, or even more than doubling year over year. This is exactly the kind of top-line velocity that makes growth investors salivate. And this next metric brilliantly illustrates the strength of their core service offering. The gross profit margin sits at a very healthy 49.25%. Basically, this means that before we account for overhead, debt, and corporate expenses, Applied Digital keeps essentially half of the revenue it generates just from delivering its core product. On a gross level, the underlying business mechanics look really robust. Part 3. Profitability and cash squeeze. Time to look at the true cost of all this growth. So here is the absolute crux of this paradox. We just saw that Applied Digital brings in an impressive $317.4 million in revenue, right? Well, their free cash flow over that exact same period is negative $1.8 billion. Just let that sink in for a second. They are generating hundreds of millions, but the cash walking out the door to fund capital expenditures and operations is a terrifying $1.8 billion in the red.
Because of that immense spend, their net profit margin completely plummets to negative 127.86%. What does that mean for us? It means that for every single dollar Applied Digital brings in as revenue, they are losing significantly more than a dollar to actually fuel their operations and scale up. The top-line growth is explosive, sure, but it is incredibly, painfully expensive to maintain.
When we check the standard profitability metrics, the internal cost of keeping this growth engine running becomes pretty obvious. The overall net income is bleeding at negative $192.3 million. The return on assets sits at negative 4.74, and the return on equity is deeply negative at 11.70. Across the board, these metrics show a company that is heavily sacrificing any semblance of current profitability in order to aggressively build out its footprint.
So you might be wondering, how do you pay for a $1.8 billion cash burn when your core operations aren't turning a profit? Well, you borrow. The debt-to-equity ratio shows a company's debt relative to its shareholder equity, and APLD currently sits at 1.68. Now, anything over 1.0 means a company relies more on debt than on equity to finance its assets. At 1.68, Applied Digital is heavily levered. They are relying on a significant amount of debt to fund this ongoing cash-burning growth strategy. Part 4. Pricing the hype. Let's see exactly how the market is valuing this whole paradox.
Let's translate some of this financial jargon. The market is clearly pricing this stock based on future expectations, not current reality. The forward price-to-earnings ratio is a dizzying, almost hard-to-believe 526. The price-to-sales ratio is over 29, and the enterprise value to sales is nearly 32. To put that into perspective, a typical value investor might look for a price-to-sales ratio under 2 or 3. At nearly 30, the market is paying a massive premium for every single dollar of sales. These extreme valuation multiples indicate a stock that is priced by the market for absolute, unmitigated perfection. In fact, the numbers are so extreme that traditional financial math literally just breaks down. If you look at standard valuation models, like the discounted cash flow model, they just stop working. They returned an NA for both fair value price and margin of safety. Why? Well, because these models rely on positive, predictable cash flows to determine what a business is fundamentally worth today. When your free cash flow is negative $1.8 billion, the traditional calculators literally just throw up their hands. And the yield metrics just hammer home that risk even further. With an enterprise value to EBITDA of negative 732 and deeply negative free cash flow and earnings yields, traditional safety nets simply do not exist here. In plain English, if you are buying this stock, you are not buying it for safe, steady returns. You are betting entirely on management's ability to eventually flip the switch from cash-burning growth to massive, scale-driven profitability.
And there you have it. The whole Applied Digital paradox summarized beautifully. On one side of the ledger, you have phenomenal, compounding revenue growth, doubling year over year, rewarding investors with astronomical, multi-100% market returns. But on the exact opposite side, you have staggering, debt-fueled costs, with billions in negative cash flow required just to keep the lights on. Which leaves us with the ultimate question. The market has obviously placed its bet, giving Applied Digital a massive premium based on its future potential. But ultimately, gravity catches up to every business, right? The high-octane growth is totally undeniable, but can APLD actually outrun its massive cash burn before the debt becomes just too heavy to carry? It is definitely one of the most compelling tightrope walks in the market right now. Thank you so much for joining me for this explainer, and I highly encourage you to keep a close eye on these metrics as the Applied Digital story continues to unfold.